So everybody now seems, Tracy, talking about potentially systemic risks again. Not surprising that the SEC seems to have jumped into action.
Yeah, well, anytime you see these types of interlinkages in the financial system pop up in the news, regulators are going to take an interest, right? And there are a couple avenues they can pursue here. So one of the most interesting things is how Archegos was using derivatives to basically build exposure to, it looks like a bunch of single stock names. It was using total return swaps, contracts for difference that allowed it to make these big leverage bets on the direction of a stock. But of course, when the stock starts going the wrong way, it all sort of collapses and there are margin calls and ultimately its prime brokers get affected. So you could see possibly the SEC taking an interest in the derivative strategy, taking an interest in the fact that a fund would be able to build up huge exposure that no one knows about through derivatives. If a fund buys an actual stock, it usually has to file ownership, and that shows up somewhere. In the case of derivatives, it seems people don't really know about it. And the other thing of interest for regulators is going to be the involvement of the prime brokers, of course. Is it normal to have 6 or 7 prime brokers providing you massive amounts of financing and leverage and seemingly not knowing what you're actually doing with that financing?
Tracy, hindsight is always 20/20 when it comes to these market explosions, but we have seen this movie before, right? Back in '98, long-term capital management. Should the banks have known better? Should regulators have done more? Well,
I think that's always a good question to be asking. Should the banks have done better? There are shades of LTCM in this. You had a bunch of banks get together and try to eke out an agreement to basically limit their losses. They were supposed to all agree not to sell or to try to hold over on selling and work out some way of disposing of the collateral in a way that would minimize losses for everyone. That doesn't seem to have happened. Instead, we had 1 or 2 banks that rushed to get out ahead of everyone else. There are also shades of Lehman Brothers to this, and I don't mean to imply that it's as systemic as an issue as Lehman Brothers, because it's not. But if you remember, Lehman Brothers used Repo 105 to conceal the true financial health of its balance sheet. You can kind of see a parallel here in the way Archegos was using derivatives to conceal its stakes, deliberately or not so deliberately. And then the final parallel here has to be with GameStop, right? We saw a bunch of retail investors pile into single stocks using a type of derivative, options contracts, to try to move the underlying price by getting a bunch of dealers to hedge out their exposure. And it seems that Archegos was doing something similar. It had big exposures to single stocks. It seems like its derivative strategy might have driven the price up. And then when things started to go wrong, it also fueled the downward movement in the price. And if you think that regulators were taking a look at GameStop, taking a look at how hedge funds were involved in that whole saga, you can bet they're going to be taking a similar look at what Archegos was doing.